All right, so picture this. You're prepping for this big investor meeting on Poonawalla Fincorp, a major player in India's financial scene. But instead of like slogging through all those dry reports, you've got us your secret weapon giving you the inside scoop.
Absolutely.
We have gone deep. We've looked at their official filings, press releases, investor presentations, even their earnings call. That's where the real juice comes out.
Yeah,
We're talking loans, ambitious growth plans, and a whole lot of AI. Are you ready to dive in?
let's do it.
So what really stood out to me is that Poonawalla Fincorp isn't just aiming for growth. They're aiming for like a full-on transformation.
A complete transformation
Their goal is to become 5 to 6 times their current size.
in the next 5 years.
That's huge,
Yeah.
especially in such a competitive market like India. What's the strategy behind this massive expansion?
Well, they're shifting from a narrow focus on just a few core products to offering almost a dozen.
Yeah.
And they're catering to everyone from individuals to large corporations.
Yeah. Okay, so it's not just growth for growth's sake. It's about strategic diversification, capturing a larger slice of the pie. But can they pull it off? What are their Q3 results telling us?
The numbers were very encouraging. Their assets under management, or AUM, have jumped a whopping 41% year over year.
Whoa, that's significant growth by any measure, but rapid growth can sometimes come at the cost of quality. What about their credit quality? Are they just like throwing money at any borrower who walks through the door?
Not at all. In fact, their credit quality has also improved, which is a really positive sign.
Okay, so fewer loans are going bad.
Exactly, meaning they're managing risk effectively even as they expand rapidly.
That's impressive. It sounds like they're striking this delicate balance between this really aggressive growth and then being really prudent about risk management. What's
Right.
their secret sauce?
One key ingredient is their focus on people. They've been on a hiring spree, particularly at the leadership level, bringing in new talent to drive this transformation.
Yeah, a new CEO often brings a new vision, and in this case, it seems to be working. But they're not just relying on human expertise, are they? I've heard whispers about their AI initiatives.
They're not just dipping their toes into the world of AI. They are diving headfirst.
Whoa.
Their goal is to become AI first in many of their operations, from hiring and lending to even collections.
That's a bold statement, but what does it actually mean in practice? How are they using AI to gain an edge?
Take their hiring process. They've implemented AI-powered tools that have slashed the time it takes to make job offers by a staggering 90%.
90%? Are you serious?
It's true, and this allows them to snag top talent in a super competitive market.
That's impressive in today's business world. Speed is key. But it's not just about efficiency, is it? AI has the potential to fundamentally change how they do business?
Absolutely. They're using AI to crunch massive amounts of data, identify patterns, and make smarter lending decisions.
So it allows them to assess risk more accurately.
Right, personalized loan offers, and even automate manual processes.
So they're leveraging AI to create this more efficient data-driven lending process. But what about their target market? India is a vast and diverse country. Are they trying to be everything to everyone?
They've articulated what they call their Bharat strategy, which is all about capturing the aspirations of the diverse Indian market.
Okay, so not a one-size-fits-all approach.
Nope. This means developing products and services tailored to the specific needs of different customer segments.
So they're recognizing those nuances of the Indian market and tailoring their offerings accordingly. Let's dive into some specifics. What kind of new products are they rolling out?
They're expanding into areas like Prime PL, a digital lending platform for middle-income earners, with a 247 online option.
So meeting customers where they are digitally, what else?
They're also pushing into gold loans, a more traditional product but still very popular in India.
Yeah, it's a classic.
They're aiming to open a whopping 400 new branches, specifically for gold loans, indicating they see massive potential in this segment.
That's a significant investment. It shows they're serious about capturing that market share. But are they just focusing on those traditional products, or are they venturing into some new territory?
They're also stepping into consumer durable financing, tapping into that growing desire for things like appliances, electronics, and other big-ticket items.
As India's middle class keeps growing and their purchasing power increases, it seems like a very smart move. This diversification suggests they're aiming for a more balanced portfolio, less reliant on any single product or market segment.
Precisely. And they're not stopping there. They're also planning to enter the equipment leasing market.
Oh, wow. So they're serious about supporting larger businesses as well.
They are.
This all points to a company that's thinking big, aiming for that really comprehensive presence across the Indian financial landscape. But let's get back to their AI revolution. It's one thing to say you're AI first, but how's that playing out in their actual operations?
They're using AI to make those smarter lending decisions we talked about by analyzing tons of data, including alternative data sources that go beyond the traditional credit scores.
So they're able to assess risk more accurately.
Yes, and lend to borrowers who might otherwise be overlooked by those more traditional lenders.
Expanding access to credit, potentially reaching those underserved populations, but AI also has implications for risk management, doesn't it? Especially as they're pursuing such aggressive growth.
They're taking a multi-pronged approach to risk management, and AI is a key part of that. They're using AI to refine their risk calibration models, and that's actually led to improved delinquency rates.
So fewer loans are going bad.
Exactly. So they're not just using AI to grow their loan book, but also to ensure that growth is sustainable and doesn't come back to bite them.
What other risk mitigation strategies are they employing?
They're also emphasizing granular customer segmentation.
Okay, so break it down for me.
By dividing their customers into smaller, more homogeneous groups based on various factors, they can assess risk more accurately and tailor their products and services more effectively.
So a smarter, more targeted approach to risk management, but they're not just relying on internal data, are they? What about external sources?
They're leveraging alternative data sources like banking information to get a more complete view of a borrower's financial situation, and this helps them make more informed lending decisions.
This paints a picture of a company that's not just throwing technology at problems, but strategically using AI to make their entire operation more efficient, more data-driven, and ultimately more profitable. But they're not just focusing on new business. They've also had some challenges with their legacy loan book, haven't they?
You're right, they've had to address their older loan book, particularly their short-term personal loans, which have seen some delinquency issues, and they've taken some decisive action to clean up that portfolio.
Okay, so what steps have they taken? Have they just swept it under the rug?
Not at all. They've made one-time provisions and write-offs on those older loans. Think of it like cleaning house, getting rid of the clutter to make way for new and better things.
So they're acknowledging the issue, taking their lumps, and moving forward with a cleaner balance sheet. It's a sign of responsible financial management, even as they're pushing for this rapid growth.
It indicates a long-term vision and a willingness to make those tough decisions to ensure sustainability.
But all of this, the AI, the new products, the risk management, it wouldn't be possible without a solid technological foundation, would it?
You're absolutely right. What does their tech strategy look like? Are they investing in building their own systems, or are they leveraging existing solutions?
What's the approach?
They're building a modern tech infrastructure, but they're not trying to reinvent the wheel. They're leveraging industry-ready software as a service, or SaaS applications, wherever possible.
That's smart. Why build it from scratch when you can use existing solutions that are already proven and reliable? But they're not just plugging in off-the-shelf software, are they?
No, they're also making those strategic investments in marketing technologies that allow them to personalize their offerings and target their marketing efforts more effectively. Remember their focus on customer segmentation. This is where it comes into play.
Right. So they're using technology to create a more personalized and engaging customer experience, which is absolutely critical in today's competitive market. But what about the underlying infrastructure? Are they building their own data centers, or are they going the cloud route?
They're migrating to a hybrid cloud strategy, which combines the best of both worlds.
Best of both worlds. How so?
They can leverage the scalability and affordability of public cloud platforms while also maintaining the security and control of a private cloud environment.
So it's a balanced approach that gives them the flexibility to adapt to changing needs and regulatory requirements. Speaking of regulations, they're operating in a complex and constantly changing regulatory landscape in India. How are they handling that?
They're not taking compliance lightly. They're actively ensuring they meet all data protection laws and are building a robust compliance framework into their operations.
So they're not just focused on growth and innovation, they're also prioritizing responsibility and sustainability. It's a holistic approach that bodes well for their long-term success. But with all this talk about technology, let's not forget about the numbers. What do their Q3 financials tell us about their overall performance? Let's dive into the details in the next part of our deep dive.
Sounds good. Let's do it. Their financials for Q3 paint a pretty compelling picture. Their net interest income, including fees and other income, hit 672 crore, a 22% jump compared to the same period last year.
That's a healthy increase, especially considering their shift towards a higher proportion of secured loans, which usually come with lower interest rates. Does this mean they're sacrificing profitability for growth?
Not at all. Their pre-provisioning operating profit, or PPOP, reached 372 crore, and when we adjust for some unusual items in the previous quarter, it shows a solid upward trend.
Okay, so they're growing their loan book, maintaining healthy profitability and managing costs effectively. But let's talk about the elephant in the room. Their legacy short-term personal loan or STPL portfolio. We know they've had some challenges with delinquencies in the past. How is that impacting their overall asset quality?
That's the interesting part. Despite those issues with that older STPL book, their gross non-performing asset ratio, or gross NPA ratio, actually went down by 25 basis points compared to last quarter, landing at 1.85%.
Wait, their bad loan ratio decreased even with the baggage of that older portfolio. That's pretty remarkable.
It is, and their net NPA ratio, which factors in provisions set aside for potential losses, stands at a very healthy 0.81%. They've also reported a provision coverage ratio of 56.79%, meaning they've built a good buffer to absorb potential losses.
Okay. I'm starting to see why this company is generating so much buzz, but rapid growth requires a lot of fuel. Can they keep this momentum going without running into funding issues?
They've been proactive on that front. They've diversified their funding sources, which reduces their reliance on any single source of capital. For instance, they secured their first ever external commercial borrowing worth 1,477 crore.
That's a savvy move. It shows they're thinking strategically about their long-term funding needs. What about their capital adequacy? Can they handle potential bumps in the road?
Their capital adequacy ratio is a comfortable 25.89%, well above what regulators require. They also have a healthy liquidity buffer of 4,808 crore, giving them a nice cushion to absorb any unexpected shocks.
So they're firing on all cylinders, strong growth, healthy profitability, improving asset quality, diverse funding sources, and solid capital adequacy. It almost sounds too good to be true. What are the potential risks we should be aware of?
Well, executing on such an ambitious growth plan is never easy. Integrating all these new products and initiatives, managing the risk associated with their aggressive AI adoption, and navigating that ever-changing regulatory environment in India are all significant challenges they'll need to overcome.
So while the future looks bright for Poonawalla Fincorp, there are still those potential pitfalls. It'll be interesting to watch their progress over the next few quarters to see if they can maintain this momentum and really deliver on their promises. But let's get back to their AI strategy. We've talked about it in general terms, but I'm curious about specific use cases. What does this AI-first mindset look like in practice?
We've already touched on their use of AI in hiring, but they're also applying it to other areas like customer service, as their CEO, Arvind Kapil, explained in the earnings call. They're developing an AI-powered conversational agent to support employees. Think of it like a virtual HR assistant.
That's interesting. It could free up HR staff to focus on those more strategic tasks. But how are they using AI to actually enhance their core lending business?
They're using AI techniques to refine their credit scoring and risk management models. The goal is to reduce default rates, speed up loan approvals, and lower processing costs.
So they're not just relying on traditional credit bureau data and human judgment. They're leveraging AI to make those processes more efficient and data-driven.
Exactly. And they're applying AI to their collections process as well. They're using AI-powered digital nudges to guide customers towards repayment and optimize their collection strategies. They're even experimenting with AI-powered virtual agents to assist with collections.
It sounds like they're leaving no stone unturned in their quest to become that AI-first organization, but are they considering the ethical implications of such widespread AI adoption?
Arvind Kapil acknowledged in the earnings call that they're very aware of the risks associated with AI. They're putting governance frameworks and monitoring systems in place to ensure they're using this technology responsibly.
That's reassuring. It's one thing to be innovative, but it's another to be ethical and responsible. But all of these AI initiatives require a robust technological infrastructure. Can their current systems handle the load?
That's where their technology strategy comes in. They're adopting a hybrid cloud approach, combining public and private cloud environments. This gives them the flexibility to scale their AI applications effectively while ensuring data security and compliance.
Okay, so they're building a foundation that can support their AI-powered future, but it's not just about the technology itself, is it? It's also about how they manage and utilize those vast amounts of data they're collecting.
Absolutely. They're implementing a customer data platform to centralize and analyze all their customer data. This allows them to gain deeper insights into customer behavior, personalize their offerings, and ultimately make better business decisions.
So they're not just hoarding data, they're actually using it to improve their operations and create a more personalized customer experience.
And they're doing so responsibly. They're emphasizing compliance with data protection laws, recognize the importance of safeguarding customer information.
This holistic approach, combining technological innovation with a strong commitment to data ethics and security, seems to be resonating with investors. Their stock has been performing well, reflecting growing confidence in their ability to execute on their ambitious strategy.
It seems
So Poonawalla Fincorp is a company on the move. They're transforming themselves from a traditional lender into this AI-powered financial powerhouse. And they're doing it with a clear focus on growth profitability and responsible innovation.
it's a compelling story, and we're just starting to see how it all unfolds.
Yeah.
But let's shift gears for a moment and take a closer look at their risk management approach.
Mhm.
It's one thing to embrace AI and pursue rapid growth, but it's another to do so responsibly.
You're right. It's easy to get swept up in all the excitement of this innovation, but we need to remember that every business decision, every technological advancement comes with inherent risks. How is Poonawalla Fincorp mitigating those risks in this fast-paced environment?
Their Chief Credit and Analytics Officer, Shriyam Iyer, outlined their multifaceted risk management strategy in the earnings call, and it's clear they're not leaving anything to chance.
Okay, walk me through it. What's their secret sauce for managing risk in this rapidly evolving landscape?
They've built their approach around three key pillars: people, design, and process. They've assembled a highly skilled team with extensive experience in credit risk analytics and debt management.
So they've got the right people in place, the experts who understand the complexities of risk management.
Exactly. And they're not just relying on experience and gut feeling. They're leveraging data and technology to create robust risk frameworks. Their approach is data-driven, combining traditional credit bureau data with alternative sources to segment customers more effectively and make more accurate risk assessments.
So it's a more granular, nuanced approach to risk assessment, moving beyond the traditional credit score to get that more holistic view of the borrower.
Exactly. And they're incorporating AI and machine learning into their credit risk models, automating some decisions to streamline the process. This allows them to process applications more quickly and efficiently.
It sounds like they're striking that balance between human expertise and the power of AI, using technology to augment their human capabilities rather than replace them entirely.
Absolutely. They're also using account aggregators to access real-time banking data, which gives a more current snapshot of a customer's financial situation than traditional credit reports.
That's smart. It helps them avoid making lending decisions based on outdated information. But how does this translate into their product development? Are they applying these principles to their new digital lending platform?
They've baked these same principles into their new digital lending platform, which offers 247 personal loans to employees of top-tier companies.
Sounds like they've carefully considered the risks associated with this digital offering, which is known for its speed and convenience. Have they sacrificed risk management for the sake of speed and innovation?
Not at all. They've implemented a robust risk management framework incorporating best practices and multiple decision points throughout the loan process. They're not just throwing technology at the problem. They're ensuring that every step from application to approval to disbursement is carefully managed.
That's reassuring. But what about their existing book of business, particularly that STPL portfolio that's caused them some headaches? How are they managing that risk?
They've dynamically recalibrated their STPL book, which has actually led to a 50% improvement in early delinquency rates.
That's a significant improvement. What specific actions did they take to achieve that?
They've refined their risk calibration models and are acquiring new exposures across various product categories with a more prudent approach.
So they've tightened their lending standards and are being more selective about who they lend to. They're not just chasing growth at any cost.
Precisely. And they're not just focusing on credit risk, they're also strengthening their collections processes.
What does that look like? Are they resorting to any aggressive tactics?
Not at all. They've implemented an automated no-contact collections approach. They're leveraging digital channels to recover those outstanding loans more efficiently, minimizing the need for those uncomfortable phone calls or personal visits.
So they're bringing a data-driven approach to collections as well, using technology to personalize their outreach and make the process less intrusive for borrowers.
Exactly. And they're constantly refining their processes, bringing in standardization across different products and geographic regions. This helps ensure consistency and efficiency across their entire operation.
It sounds like they're creating a more robust, scalable, and customer-centric risk management framework. But are they relying solely on their internal expertise, or are they looking to external resources as well?
They're collaborating with IIT Mumbai to further enhance their risk management capabilities using AI and machine learning. They're even developing an AI-powered credit assistant to streamline credit processing and automate credit checks.
That's innovative. So they're not just using AI to manage risk, but also to make their risk management processes more efficient and accurate. It's a double win.
And they're aiming to be the first major NBFC in India to deploy an automated campaign and collection workflow platform powered by AI and foundation models.
That's a bold ambition. They're really pushing the boundaries of what's possible with AI. But with all this experimentation, are they going too far too fast? Could they be taking on too much risk in their pursuit of innovation?
That's always a risk with any disruptive technology.
Mm.
But they seem to be striking a balance between innovation and prudence. They're not just blindly throwing AI at every problem. They're carefully selecting use cases where it can deliver real value while mitigating those potential risks.
It's a delicate balancing act, but so far they seem to be managing it effectively. They're improving asset quality, and their confidence in resuming growth in previously challenging areas like SDPL speaks volumes about their ability to balance risk and reward.
It's a testament to their commitment to responsible innovation, and it really sets a positive example for other financial institutions looking to embrace AI while navigating the complexities of risk management.
It's a story that's still unfolding, but the early chapters are certainly promising. But let's zoom out for a moment and consider the bigger picture. Poonawalla Fincorp's transformation isn't just about them, is it? They're potentially changing the whole landscape of finance in India.
You're absolutely right. Their aggressive adoption of AI, their focus on digital lending, and their ambitious growth plans are challenging the traditional ways of doing business in the financial services industry. They're raising the bar for innovation and customer centricity.
So they're not just competing with other financial institutions. They're disrupting the whole industry, forcing others to either adapt or risk being left behind.
Exactly. Their success could inspire a wave of AI-powered innovation across the sector, ultimately benefiting both consumers and businesses. Imagine a future where financial services are faster, more convenient, and more personalized thanks to the widespread adoption of AI.
It's an exciting vision, but it's not just about technology, is it? Poonawalla Fincorp's success also hinges on their deep understanding of the Indian market and their commitment to serving the needs of that diverse Indian population.
Their Parat strategy, with its focus on tailoring products and services to those unique characteristics of the Indian market, is a key differentiator. They're not just trying to replicate what's working in other markets, they're building a business that's uniquely Indian.
And their success could have a profound impact on financial inclusion in India, bringing those essential financial services to a wider population, particularly those who've been traditionally excluded from the formal financial system.
Absolutely. Their use of technology to reach underserved communities could be a game changer for financial inclusion in India. It's a powerful example of how technology can be used to create positive social impact.
It's a story that's still being written, and it'll be fascinating to see how Poonawalla Fincorp's journey unfolds and how it shapes the future of finance in India. But we can't ignore those potential challenges they face. The regulatory landscape in India is constantly evolving, and they'll need to stay agile to keep pace.
That's right. And the competition is heating up. Other financial institutions are also investing heavily in AI and digital capabilities. Poonawalla Fincorp will need to maintain its innovative edge and continue to differentiate itself to stay ahead of the pack.
So they're not out of the woods yet. They need to keep pushing boundaries, keep innovating, and keep adapting to stay ahead of the curve.
Absolutely. But with their visionary leadership, their talented team, and their commitment to responsible innovation, they seem well equipped to navigate these challenges and continue their remarkable growth trajectory.
It's a story that's worth watching closely, but let's zoom in on one specific element of their strategy that really stood out to me, their commitment to building a unified technology stack. What's the significance of that, and why is it such a game changer?
It's all about creating a seamless and integrated experience for their customers. Instead of having separate systems for different products and processes, they're building a single platform that can handle everything from customer onboarding and loan servicing to collections.
So it's like creating a one-stop shop for all their financial services, streamlining the experience for both their customers and their employees.
Exactly, and this has numerous advantages. First, it simplifies things for their customers, making it easier to interact with the company across multiple touch points, no more jumping through hoops or dealing with different departments for different services.
It makes the entire experience more user-friendly and efficient.
Right. And it also streamlines their internal operations, reducing complexity and improving efficiency. This allows them to operate more effectively and at a lower cost.
So it's a win-win for both the company and its customers.
Precisely. And perhaps most importantly, a unified tech stack lays the foundation for data-driven decision-making, with all their customer data in one central location. They can gain deeper insights into customer behavior, personalize their offerings, and make more informed lending decisions.
It sounds like a strategic move that yields both operational and strategic benefits.
Absolutely. And it's a key enabler of their AI-first strategy. With the unified tech stack, they can more easily deploy AI applications across their entire business, from credit scoring and marketing to customer service.
It's like creating a superhighway for AI to flow seamlessly throughout their organization.
Exactly. And this gives them a significant competitive advantage. They can move faster, innovate more quickly, and deliver a more personalized and responsive customer experience than their rivals.
It's a smart move and one that other financial institutions would be wise to emulate. But a unified tech stack is only as good as the data it's built on. How are they managing and leveraging all the data they're collecting?
That's where their customer data platform, or CDP, comes into play. A CDP is like a central hub for all their customer data. It allows them to collect, clean, organize, and analyze data from various sources, creating a unified view of each customer.
So it's like creating a master profile for each customer, combining data from all their interactions with the company across different channels and touch points.
Precisely. And this has numerous benefits. First, it allows them to personalize their marketing efforts with a deeper understanding of their customers. They can tailor their messages and offers to individual preferences, making their marketing more effective and less intrusive.
So no more generic marketing blasts that annoy customers. They can target their marketing efforts more precisely, reaching the right people with the right message at the right time.
Exactly. And a CDP also enables them to provide better customer service with a comprehensive view of a customer's history and interactions. They can provide more personalized and relevant support.
So they can anticipate customer needs and provide proactive assistance resolving issues before they escalate.
Right. And perhaps most importantly, a CDP allows them to make more data-driven decisions across the board. With a comprehensive understanding of their customer base, they can make better decisions about product development, risk management, and their overall business strategy.
So it's not just about marketing and customer service. It's about making smarter decisions across all aspects of their business. They're really embracing the power of data.
Absolutely. And they're doing so responsibly. They're emphasizing compliance with data protection laws and implementing strong security measures to safeguard customer information.
This focus on data ethics and security is crucial, especially in a market where consumers are becoming increasingly concerned about how their data is being used. It's a smart move both ethically and strategically.
Now let's talk about their cloud strategy. They've mentioned migrating to a hybrid cloud model which combines public and private cloud environments. Why is that significant?
I'm curious about that as well. It seems like a more complex approach than simply going all in on the public cloud.
It's about striking that right balance between flexibility, security, and cost. Public clouds offer scalability and affordability, allowing them to quickly ramp up their resources as needed. Private clouds, on the other hand, provide enhanced security and control, which is crucial for sensitive customer data. By combining the two, they get the best of both worlds.
So they can leverage the scalability and cost effectiveness of the public cloud for certain applications while maintaining the security and control of a private cloud for more sensitive data and workloads.
Exactly. And a hybrid cloud approach also helps them meet those evolving regulatory requirements, particularly in areas like data privacy and sovereignty.
So they're not just thinking about technology, they're also considering that regulatory landscape and ensuring they're compliant with all applicable laws and regulations.
Absolutely. And they're taking data security very seriously. They're implementing next-generation security techniques to protect their systems and customer data from those ever-evolving threats.
It's a comprehensive approach to cloud security, recognizing that data protection is paramount in today's digital world. But their cloud strategy isn't just about technology and compliance, is it? It's also about supporting their ambitious business goals.
You're absolutely right. By leveraging the scalability and flexibility of the cloud, they can more easily launch new products and services, expand into new markets, and support their aggressive growth plans.
So their cloud strategy is a key enabler of their overall business strategy, providing the foundation for innovation and agility.
Precisely, it's about creating a platform that allows them to respond quickly to market opportunities and customer needs, which is crucial in a dynamic and rapidly evolving market like India.
Speaking of the Indian market, let's circle back to their Far Out strategy and talk about how their technology approach aligns with their ambition to serve the diverse needs of the Indian population.
Their commitment to building a unified tech stack, implementing a CDP, and adopting a hybrid cloud model all contribute to their ability to reach a wider audience and tailor their offerings to specific customer needs with a more agile and scalable technology infrastructure. They can easily customize their products and services to meet the unique requirements of different customer segments.
So they're using technology to break down traditional barriers and make financial services more accessible and relevant to everyone in India. It's a powerful example of how technology can be a force for inclusion and empowerment.
And their focus on data privacy is particularly relevant in a market where many people are new to digital financial services and may be hesitant to share their personal information. By demonstrating their commitment to data protection, they're building trust and encouraging wider adoption of their services.
It's a smart approach combining technological innovation with a deep understanding of the cultural and social nuances of the Indian market.
And their success could have a transformative impact on financial inclusion in India, extending essential financial services to a larger segment of the population, particularly those in rural areas and underserved communities.
It's an exciting prospect and one that we'll be watching closely, but let's get more specific. Can you give me some concrete examples of how they're using technology to really cater to the Indian market?
One example is their digital lending platform, which offers instant 2047 personal loans. This is particularly valuable in a market where many people lack access to traditional banking services and need quick access to credit for emergencies or unexpected expenses.
So they're meeting a real need in the market, providing a valuable service to those who might otherwise be excluded from the formal financial system.
Exactly. And they're using AI to streamline the lending process, making it faster and more convenient for borrowers. This reduces friction and makes the whole experience more user-friendly.
Less paperwork, less hassle, more speed and efficiency.
Precisely. And they're also using AI to personalize their marketing and customer service, tailoring their communications to individual preferences and needs. This is especially important in a diverse market like India, where cultural sensitivities and language barriers can create challenges for businesses.
So they're using AI to bridge those gaps and create a more inclusive and personalized customer experience that resonates with a wider audience.
Exactly. And they're not just focusing on digital channels, they're also expanding their physical presence with plans to open 400 new branches,
Yeah.
primarily in rural areas and underserved communities.
It's a balanced approach combining digital innovation with a physical presence in areas where it's most needed. They're not forgetting about those who may not have easy access to the internet or prefer face-to-face interactions.
Right, and they're using technology to bridge the gap between the physical and digital worlds, for example. Their app provides customers with access to a wide range of services, including account management loan applications and financial education resources, whether they're online or offline.
So they're creating a more seamless and integrated experience for their customers regardless of how they choose to interact with the company.
It's a well-thought-out strategy, leveraging technology to address those unique challenges and opportunities of the Indian market. And it's clearly paying off. Their strong financial performance and ambitious growth plans are a testament to the effectiveness of their approach.
Now let's dive into their product strategy. They're expanding beyond traditional lending products and venturing into new areas like gold loans, consumer durable financing, and equipment leasing. What's driving this diversification?
It's all about tapping into that growing demand for financial services in India, particularly among segments of the population that have been traditionally underserved by those traditional financial institutions.
So they're identifying unmet needs and developing products and services to fill those gaps. It's a smart growth strategy.
Gold loans, for example, are a popular form of credit in India, especially in rural areas where many people may not have formal credit histories or collateral other than gold. Poonawalla Fincorp is stepping in to meet this need by expanding its gold loan offerings.
So they're providing an alternative to those traditional lending options, making credit more accessible to those who might not qualify for conventional loans.
Exactly, and consumer durable financing is catering to those rising aspirations of India's growing middle class. It's making it easier for people to purchase appliances, electronics, and other big-ticket items that can improve their quality of life.
So they're supporting the growth of the consumer economy in India, providing a boost to both consumers and businesses.
Precisely. And equipment leasing is targeting businesses, providing them with an alternative to traditional financing options for acquiring essential equipment. This helps businesses conserve their capital for other investments and can make it easier for them to upgrade their equipment and stay competitive.
So they're supporting the growth of businesses in India, which ultimately benefits the overall economy.
Exactly. By diversifying their product portfolio, they're reducing their reliance on any single product category and creating multiple avenues for growth. It's a smart strategy for mitigating risk and maximizing their market potential.
It makes sense they're spreading their bets, so to speak, and not putting all their eggs in one basket. But are they just launching new products, or are they also innovating within those existing categories?
They're doing both. Their new Prime PL product, for example, targets middle-income earners with a streamlined digital lending experience. They're offering loans of up to 75 lakhs with tenures ranging from 6 to 48 months.
So they're not just focusing on underserved segments, they're also targeting prime customers with innovative digital solutions. They're really catering to the evolving needs of borrowers, recognizing that today's customers expect a fast, convenient, and personalized experience, regardless of their income level or credit history.
Absolutely. They're blending product diversification with innovation within existing categories to capture a wider share of the market and appeal to a broader range of customers. It's a comprehensive approach that positions them for sustainable growth.
Now let's talk about their distribution strategy. They're clearly expanding beyond traditional branches, but how are they leveraging digital channels and partnerships to reach a wider audience?
They're investing heavily in their digital capabilities, constantly enhancing their website and mobile app to provide a more seamless and engaging customer experience. They're also active on social media and other online channels to connect with potential customers and build brand awareness.
So they're meeting customers where they are online and on their mobile devices, recognizing that a growing segment of the population prefers to manage their financial lives digitally.
Exactly. And they're forming strategic partnerships with other businesses to extend their reach and tap into new customer segments. For example, they're partnering with retailers to offer consumer durable financing at the point of sale. This makes it easier for customers to finance their purchases and can boost sales for those retailers.
It's a smart strategy that creates a win-win for both parties, but they're not just relying on technology and partnerships. Are they also expanding their physical footprint?
Yes, they are. They're strategically expanding their network of direct selling agents or DSAs who play a crucial role in connecting them with borrowers in rural areas and underserved communities where internet access may be limited or where customers prefer face-to-face interactions.
So they're blending digital innovation with a human touch, recognizing that a personalized relationship-driven approach is still important in many parts of India. It's a balanced strategy that combines the best of both worlds.
Absolutely, and their multifaceted distribution strategy is proving to be very effective. It's allowing them to reach a wider audience, penetrate new markets, and accelerate their growth trajectory.
It's a comprehensive approach, leveraging technology partnerships and a strong on-the-ground presence to capture a greater share of the Indian market and expand their customer base.
Now let's talk about their people strategy. They're clearly investing heavily in attracting and developing talent, recognizing that their people are their most valuable asset. What are they doing to build a strong and engaged workforce?
I'm curious about that as well. In today's competitive market, attracting and retaining top talent is crucial for any company's success, especially one that's growing as rapidly as Poonawalla Fincorp.
They've assembled a really strong leadership team with deep experience in the financial services industry. They're also cultivating a culture of innovation and agility, empowering their employees to think creatively, take ownership of their work, and really contribute to the company's success.
So they're creating a work environment that fosters collaboration, innovation, and personal growth, which is very attractive to top talent.
Precisely. And they're investing in training and development programs to upskill their workforce and prepare them for the challenges of the future. They're not just hiring people with the right skills today. They're investing in their long-term development to ensure they have the skills they need to thrive in a rapidly evolving industry.
So they're not just hiring for today, they're hiring for tomorrow. It's a forward-thinking approach that will pay dividends in the long run.
And they're leveraging technology to streamline their human resources processes. They're using AI-powered solutions to simplify recruitment onboarding and employee support, freeing up HR staff to focus on more strategic initiatives.
So they're using technology to make HR more efficient and effective, which is essential for any company that's growing rapidly and needs to onboard new employees quickly and seamlessly.
Exactly. Their people-centric approach is paying off. They're attracting top talent and creating a highly engaged and motivated workforce, which is essential for any company that's aiming to disrupt an industry and achieve ambitious goals.
It's a smart strategy for building a sustainable and successful business. But let's talk about their commitment to environmental, social, and governance, or ESG principles. How are they incorporating ESG considerations into their operations and decision-making?
They're integrating ESG factors into their lending decisions, promoting responsible lending practices, and supporting businesses that align with their values. They're also promoting diversity and inclusion within their workforce, creating a more equitable and representative organization.
So they're walking the talk when it comes to social responsibility. They're not just paying lip service to ESG, they're taking concrete actions to make a positive impact on society and the environment.
Absolutely, and they're implementing strong governance structures to ensure accountability and transparency in all their operations. They're committed to building a sustainable and ethical business that benefits not just their shareholders, but also their employees, their customers, and the communities they serve.
It's a holistic approach that recognizes the interconnectedness of business society and the environment. It's about creating value for all stakeholders, not just maximizing profits for the few.
Exactly. And their commitment to ESG principles is not just good for society, it's also good for business. It helps them attract and retain top talent, build trust with customers and investors, and mitigate reputational risks.
It's a win-win situation. It demonstrates that they're not just focused on short-term profits, they're thinking about the long-term sustainability of their business and their impact on the world around them.
Now let's talk about the regulatory landscape in India. The financial services sector is heavily regulated, and companies operating in this space need to be acutely aware of the rules of the game. What are the key trends they're facing, and how are they navigating this complex regulatory environment?
That's a crucial aspect of their business. The regulatory landscape can be a minefield, and any misstep can result in hefty fines or reputational damage. How are they ensuring they stay on the right side of the regulators?
The Indian government is actively promoting financial inclusion and encouraging innovation in the financial services sector. They're introducing new regulations and policies designed to support the growth of fintech companies like Poonawalla Fincorp and expand access to financial services for those who've been traditionally excluded from the formal financial system.
So the regulatory environment is generally supportive of their ambitions. They're operating in a market where the government is actively encouraging the kind of innovation and disruption they're bringing to the table.
Exactly. But it's not all smooth sailing. Regulators are also focused on consumer protection and data privacy, which is understandable given the increasing risks of fraud and data breaches. They're introducing stricter rules to safeguard customer information and ensure that financial institutions are operating responsibly and ethically.
So it's a balancing act. They need to navigate a complex regulatory landscape, balancing the need for innovation and growth with the need to protect consumers and their data.
Precisely. And they're doing so effectively. They're actively engaging with regulators, ensuring they're compliant with existing and upcoming regulations, and building a strong culture of compliance within their organization. They're not taking a reactive approach, waiting for regulators to crack down. They're being proactive, staying ahead of the curve, and ensuring that compliance is embedded in their DNA.
That's a smart approach. It shows they're taking compliance seriously, not just as a box-ticking exercise, but as a strategic imperative that's essential for their long-term success and sustainability.
Now let's talk about the competitive landscape in India. They're operating in a crowded and dynamic market. Who are their main rivals, and how are they differentiating themselves?
That's a key question. Every business faces competition, and the financial services industry is no exception. What are they doing to stand out from the crowd and win over customers in this cutthroat market?
They face competition from both traditional banks, which have a long history and deep pockets, and other non-banking financial companies, or NBFCs, which are often more agile, and customer-centric traditional banks have the advantage of a large customer base and extensive branch networks, but they can be slow to adapt to new technologies and changing customer preferences. NBFCs, on the other hand, are often more nimble and innovative, but they may lack the scale and resources of those larger banks.
So Poonawalla Fincorp is kind of in the middle.
They're an NBFC, but they're aiming to compete with the big banks by leveraging technology and data to create a more personalized and efficient experience.
So they're combining the best of both worlds, the agility of an NBFC with the ambition and scale of a traditional bank.
Exactly. And they're not afraid to challenge the status quo. They're not just trying to imitate what others are doing. They're forging their own path. And that's what makes them so interesting.
It's a bold strategy, but one that seems to be paying off. Their commitment to innovation and customer centricity is resonating with borrowers and investors alike. But as we've discussed, they face some stiff competition. How are they differentiating themselves from the pack?
Their focus on AI is a major differentiator. They're not just using AI to automate existing processes. They're using it to fundamentally change how they do business. They're using AI to make smarter lending decisions, personalize their marketing, and provide more responsive customer service.
They're creating a more data-driven and customer-centric experience, which is what today's borrowers are looking for.
Exactly. And they're not just focusing on technology, they're also investing in their people, building a strong and engaged workforce that's empowered to innovate and deliver exceptional customer service.
They recognize that their people are their most valuable asset.
Absolutely.
Yeah.
And they're committed to responsible innovation. They're not just chasing profits, they're also considering the ethical implications of their actions and striving to make a positive impact on society and the environment.
So they're building a sustainable and ethical business, one that's not just good for their bottom line, but also good for the world around them.
Exactly. And that's what makes them such a compelling story.
Well, it's been fascinating to take this deep dive into the world of Poonawalla Fincorp, a company that's clearly on the move and one that's reshaping the Indian financial landscape with their bold vision, ambitious growth plans, and commitment to responsible innovation. They're a company to watch, and we'll certainly be keeping a close eye on their progress in the years to come.
Absolutely. And we'll be back to bring you more in-depth analysis and insights on the companies and trends that are shaping the future. So stay tuned.
Thanks for joining us on this deep dive. Until next time, keep exploring, keep learning, and keep pushing the boundaries of what's possible.